Welcome to Global Money Talk, brought to you by Sunpro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and today I'm joined by Dan Ha, partner at Karani Asset Management. Dan, welcome to the show again.
Hey, thank you. Thanks for having me.
It's great to have you here. It's been quite a week, and I think we've already seen some action again today, thanks to Chair Powell yesterday. A little bit of surprise on the comments. So, how was this week for you?
Yeah, pretty choppy week, obviously. We did just fine. We didn't have any, as I shared on the show before, we didn't have any explicit Trump trades going into the election. We didn't have any Harris trades going into the election either. We were largely sort of neutral about it. Obviously, that meant that we didn't fully participate in the big rally following the election results. Having said that, we obviously had things in our portfolio that did benefit, although they were never meant to be, quote, Trump trades. But then we also had stuff in the portfolio that didn't benefit as much. Now, it was obviously, it's always tempting to chase. There was a lot of sort of media coverage and sort of rhetoric around, or commentary around how, this is a game changer and, the sentiment has shifted and animal spirits and all of that, which, by the way, may still be very much alive and well. It's only been a week, so who knows? But we didn't chase. We didn't have any Trump trades going in, and we didn't put on any new Trump trades after the results. And long story short, at least for this short week of time, it's been a good thing that we didn't chase, because something like if you take the top 100 stocks that went up the most on November 6th, the median price change was something like 16%. So those were big moves. But subsequently, from the 7th through yesterday, those same 100 stocks, the median return was actually negative, a little over negative 2%, negative 2, negative 3%. Meaning, if you didn't have those positions going into November 6th, and if you saw them go up a lot, and you said, oh my goodness, I might miss out on this, I have to buy them. Well, if you bought them, the median return for those stocks following the big jump was negative 2, negative 3%. So it's a good thing that we didn't chase, and for those who were disciplined enough not to chase, it's been a good thing. I'm sure that the numbers are a little worse now today, after today. Maybe it creates a buying opportunity for some of them, but certainly after big moves like that, I don't know, in my experience, it's not always going to be the case, but in my experience, it's been better to just kind of, take a bit of a wait and see approach, because markets can get to the extremes. They could be really optimistic and push prices up unjustifiably high, and they could get really pessimistic and push down prices unjustifiably low. So, long story short, we've been just fine, and just, we're not doing anything differently, like I said, as a result of the election. We're always just looking for high-quality companies that are perhaps underappreciated, or have, for whatever reason, a market has low expectations on them, and that's what we continue to do.
Oh, interesting what you just said here, low expectations.
Yeah.
Did you go into that a little bit further? Are you looking at potentially stocks that are sort of out of favor, maybe the best term for it? What constitutes low expectations?
Sure.
And how do you identify those?
Yeah, no, out of favor is a great way to describe it. By definition, in order to have low expectations, you can't be that popular. So being out of favor is a good way to describe it. Now, how do we kind of find those names? Well, first of all, one thing that we look at is valuation. So obviously, a company with a very high PE, it's hard to argue that it's got low expectations built into that stock. Conversely, a company with a very low PE, it's hard to argue that the market is really excited about that stock. Having said that, we think PEs in this context is much more important on a sort of relative to historical basis than on an absolute basis. What I mean by that is you could look at a company that trades at 12 times and say, wow, expectations must be really low. That's a very low multiple. Well, if it's a stock that's traded at, say, 10 times over the last 10 years, then actually you could argue that the market actually has high expectations for that stock because it's something that normally trades at 10 times, now trades at 12. Similarly, on the high side, you could look at a company that trades at, say, 20, 28 times PE and say, well, that doesn't, that seems pretty expensive. Well, but if it's a stock that historically, for a long period of time, traded in the low 30s, 35 times, then that indicates that something's up. So you can never just look at the PE on an absolute basis and just determine whether this is whether there's high expectations or low expectations, which is why comparing it to both the historical, to its own history, and also to the peers in the sector is important to find out. Because as we discussed last week, there are some sectors that are inherently going to trade at a higher multiple, and some sectors that will inherently trade at a low multiple. So looking at it, thinking about it from a relative standpoint is more helpful in trying to identify where there's been a change in expectations. And then the second thing you could look at is, what we look at is, frankly, the good old stock chart. A stock that's down a lot or a stock that's up a lot. Now, just because a stock is down a lot, that doesn't necessarily mean that it's cheap. But probabilistically speaking, when you have a stock that is down a lot, and when you're sort of looking in that general neighborhood, the likelihood that stock is sort of gotten out of favor, that expectations are low relative to the previous sort of long-run expectations for the company, your chances just go up. So it's good to, again, it's important to remind folks that just because it's down a lot doesn't mean it's necessarily cheap, and just because something's up a lot doesn't mean it's necessarily expensive. But when you kind of look at that together with where valuation levels are, it could be sort of a good sort of a two-pronged approach to trying to identify companies with low expectations. Another thing I'll say about looking for companies with low expectations that have fallen out of favor by the market, the one thing that we tend to do is we don't usually start with valuation. We generally maintain a list of sort of companies that we, high quality companies that we love to own. And then when prices change among those companies, then we start to do some more work and maybe start nibbling at it, building a position, etc., or start trimming on the opposite side. The reason why we do that is because psychology obviously plays a huge role in investment decision making, and in our experience, when we start with valuation, it's easy to sometimes talk yourself into the quality aspect of the company. Evaluation is so compelling, you're already attracted to it, you want to own it, and so you're kind of looking for reasons to own it. And that, I don't think, is a good way to pursue investments. Confirmation bias is a real thing, and so we normally start with the quality, and we already know who those companies, what those companies are, and when the market gives us a good valuation opportunity, we'll start doing some more work. So I mean, it's at any given point in time, like right now, I think there are a couple of areas in the market. Obviously post-election, a lot of things have gone up, but there are actually things that have gone down post-election. And high-quality companies in those areas are something that we're actively studying and paying attention to. For instance, there are dozens of companies in the healthcare space that have actually gone down since the election. Why? Again, you can never know exactly why, but all of this sort of uncertainty around who's going to potentially run Human and Health Services, and therefore the FDA, has created some real uncertainty, and I might even say some fear among the sort of the healthcare names that have to regularly get their drugs approved by the FDA. So increased scrutiny and perhaps making it difficult for drugs to get approved, is not going to is going to hurt the stock, because that expectation starts to get built into the stock price. So that could be an interesting area. Another interesting area could potentially be sort of the technology hardware side, companies that are involved in the semiconductor manufacturing supply chain. These companies, almost all of them, work very closely with or is somehow involved with the sort of the supply chain in Asia, and often supply to those countries. And Trump administration likely taking a harder stance on China will probably, more likely than not, make life a little more difficult for these companies, and that causes investors to sort of be negative, turn negative on the stock. So there are stocks that are actually, like I said, again, down since the election. So those could be an interesting area, because not that I'm saying that everything will be fine and things will just be status quo. I'm not saying that at all. But we always think in terms of odds. And yes, it's possible that some of these pharmaceutical companies could get really harmed by a new sort of regime at the FDA. But there's also a good chance that it's really more noise and nothing really changes that much at the end of the day. So it's a risk-reward opportunity that we find so far fairly compelling. Ultimately, you're going to have to find the right names in the portfolio or to buy in those areas. But the risk rewards are pretty compelling. So
I actually want to drill a little bit into this low expectations idea.
Sure.
And I don't know if there an example that perhaps in the past that you found a name that was a quality name but had low expectations for some reason, and you found value in that. If you're at liberty to discuss that, or if there's something that you're looking at right now which may have it's a quality but has low expectations for a reason. Just to have a name and example would be great.
Yeah. No, I mean, I'm reluctant to discuss individual names at this stage, but obviously there are plenty of examples just in the market where really high quality companies come under pressure due to reasons that are perceived to be structural, that end up just being kind of a point in time kind of a situation. Deeply cyclical companies, for example. I was listening to David Einhorn talk at a conference this past week, and he was talking about his new position in CNH, which is an ag equipment manufacturer. They supposedly they had a pretty poor earnings results most recently, and that wasn't really received well by the market. But for a deeply cyclical company, when you're in a down cycle, you're in a down cycle. Unless you're somehow going to you're going to buy it at the very low, at the very bottom. As you own this company, as it sort of goes down the cycle, the results aren't going to be that great. But that's kind of expected, right? It's going through a down cycle. If you have the courage to, or I shouldn't say just courage, but if you do the work and determine that it's actually this company 5-10 years from now is going to be in a better place, and essentially make a higher high in terms of they were at a certain point in the previous peak of the ag cycle, and 10 years from now, if you're rather confident that its sort of high point in the next peak of the cycle will be even higher, for instance, then you could actually buy this company at a really attractive valuation today, because it's going through a cyclical low point, and it's not something that investors are really all that excited to own. So, valuation, cyclicality, and therefore valuation does give us opportunities to not only buy, but also sell. When valuation gets to be really hot. So, if that's what you're doing, and if you're somebody that just sort of practices valuation discipline as sort of a key part of your investment process, it's really important to stick to sort of the factor that you've identified to be a long-term value creator, and not really chase different factors and hop around, because like right now, over the next 6 to 12 months, I think this factor is going to be hot, so you jump over, and over the following 6 to 12 months, you think some other factor is going to be hot, so you jump around. I mean, that's really difficult to do. For most investors, it's better to stick to something that works over time, and really stay with it through the thick and thin, and accept that it's not going to beat the market every single calendar year, but over time, hopefully it will.
Now, you just mentioned a term. You dive into a little bit, factors.
Yes. Yes. So factors. Sorry. The simple way to describe factors, it really means characteristics that contribute to returns. So, for example, size is a factor, meaning small cap versus large cap. There are studies, or you could run analyses to see how small caps have performed against large caps over long periods of time, and you can see how the different asset classes go in and out of favor over time. Valuation actually is a factor. So there are people who will buy simply low PE or low price to book stocks because over time it's their belief, based on their historical analysis, that will lead to outperformance over buying high PE or high price to book type stocks. There was actually a famous study by Gene Fama and Ken French of the University of Chicago, and Ken French, who's now at Dartmouth, but they came up with the famous factor model that focused on, or that demonstrated that if you consistently own a portfolio of small cap value, so smaller companies that trade at low price to book, that over time has done phenomenally well against sort of these other factors or other portfolios with other types of characteristics. So it could be pretty simple like that. You identify factors that outperform over time, and you own that, and you can construct a portfolio like that. I mean, some other factors, I know people who focus on consistent dividend growth, for example, as a factor, because they see that as a factor that contributes to outperformance over time. Geography is a factor. U.S. stocks versus non-U.S. stocks, or European stocks, Asian stocks. And sometimes it doesn't have to be, these factors don't have to be these traditional, sort of the more traditional metrics like market cap and multiple and geography. There are factors, non-traditional factors like high inside ownerships. High inside ownership, some would argue, leads to outperformance over time. So if you can create a portfolio of companies with high inside ownership, that could potentially be or that would be a factor portfolio. What we do at my firm, we focus on companies with outstanding and effective corporate cultures. Corporate culture is a factor, and we believe contributes to outperformance over time. So, you have to, there are lots of different ways to identify these factors, and you could really assemble them to create a portfolio that you think has the characteristics that together will contribute to outperformance over time.
I want to go into these factors a little bit more. It seems like there are quite a few of them. And some people want to go at low price to book or high dividend growth or inside.
Right.
A lot of different things to look at. Are there certain factors that may be quite popular that you're perhaps a little more careful with? Are there certain ones? I know we talk about corporate culture a lot.
Yeah,
I love the idea that good corporate culture, you get good surprises, and a bad one, you get bad surprises. Try to avoid that.
Yep.
I mean, I guess it's identifying. But what are some of the factors that are people that talk about that sometimes like you want to think about twice, or you want to be a little careful with?
Yeah, I mean, I don't know if I can say that certain factors are more sort of better or worse than others, like more dangerous than others. One thing on how I would answer that question is to remind folks that factors actually go in and out of favor, too. So that's what I was trying to say earlier about you don't want to be jumping around. Well, if you think you can, sure, but it's very difficult to jump around between factors. That's essentially a very sophisticated form of, or a very a micro sort of form of market timing, and we all know that market timing is very difficult. So saying that, okay, for the next 6 months, I think the size factor is going to, small caps are going to outperform, where I think over the next 6 months, value is going to outperform, or over the next 6 months or 12 months, dividend growers are going to outperform, is really quite difficult. But it's important to remember that, but that doesn't mean you shouldn't own any of these factors. What's important to remember is that factors too go in and out of, have its own cycle and go in and out of favor. So if you've identified a factor, it's important to really stick to it, because the reality is most of these factors get identified through testing over a long period of time, sometimes with real money, sometimes or often through back testing. But in my experience, at least, you don't identify a factor by testing a factor over a 6 to 12 month time frame. You're normally back testing it a couple of years, if not 10 plus years, if not decades. A factor like small cap value was tested over multiple decades. So people see that and say, oh wow, this is a factor that contributes, that this factor has alpha. And then people go and implement that factor in their portfolios and see that it's not working over a 6-month, 12-month period, and they abandon it. They say, it's not working out, and I'm going to abandon it. Well, if it's a factor that demonstrated effectiveness over a long period of time, you probably should have it in the portfolio and have the bet on for a long period of time too. Otherwise, because if you look at all these tests of factors, if you really zoom into any random 6-month, 12-month periods, it doesn't work. I don't think there's any factor that works, pick any 12-month period and beats the market every single time. Like, if you find one, let me know. Give me a call. I am quite confident that no such thing exists. Therefore, if you're going to use these factors to build a portfolio, you have to be patient, and you have to be willing to, or you have to let it play out. And letting it play out means that you have to accept that it's not going to beat the market every single calendar year. So I would say that that's the most important thing to consider. Jack Bogle, the late Jack Bogle, who founded Vanguard, famously warned against trading factors. He's the one who, there are videos of him talking about how you should just stick to them. The proliferation of the ETF market, the availability of ETFs. Now you can buy an ETF for anything and any factor. Makes it very easy for people to trade factors. But like I said, trading factors, really quite difficult. In my opinion, the better thing to do, the more effective thing to do, is identify the factors that you believe contributes to alpha, and really sticking with it and letting it play out over a reasonable period of time.
That's very interesting what you're saying about the about sort of looking at a factor and making sure that your holding period is appropriate to that factor. Insider holds. I mean, if you're trying, oh, what didn't work in 3 months, well, didn't work in 3 months
Right, right.
for obvious reasons. I read an article that you mentioned that was really interesting. It said that I didn't dive into the research, but it said that investors that actually have a consultant, a financial consultant working with them, seem to do better. And a big part of it is because they trade less. If you're sitting on your app and you have an idea and you start trading,
Right.
that's actually perhaps more risky in the long run. And it kind of goes to what you say about sticking with what your strategy and holding on and letting that strategy work. So
Right.
I guess that leads to a question: is it seems like you do a lot of fundamental research as well as into the company as well as market research. What keeps you disciplined so you're not you see a great idea and you really want to jump on it? How do you discipline yourself in terms of what you put in the portfolio and
Right.
what you get rid of actually?
Right. No, that's a great question. It's something I wrestle with every single day. I don't think it's whether you're an individual investor or professional investor. If I told you that it's not something that I worry about, that I'm not tempted to chase, or that FOMO doesn't affect me, I'd be completely lying. But it's something that I try, and my team together as a team, we try very hard to fight against. And there's really no, silver bullet in being more disciplined. You just have to, you just have to, you just have to be, you just have to practice it. Having good colleagues obviously helps so that we keep each other in check. Previously on the show, I've talked about how we as a team, we read psychology books regularly as a team. That's a great reminder for us to not behave just as whatever our psychology might tell us to do, because we're all human. We're all exposed to the same risks of sort of the risks of just behaving emotionally. So it's something that we consciously try very hard to fight against. But also, I guess practically speaking, the more important thing is you have to identify a process. You have to design a process, and identifying a factor, I would put it in that category too. You identify something that you believe works. You have to figure out a way to systematize it so that you could apply it consistently over time. If you're just kind of chasing things left and right without really having a sort of firm standing on, okay, these are the things that I'm going to focus on, then what ends up happening is for most people, you just get whipsawed around by, this is going up, oh, so I'm going to chase that. And now this is going down, so that's going up, I'm going to chase that. As I demonstrated in the sort of a short, I realize that it's only a week's time, but if you saw the names that really shot up after the election and said, wow, those are going up, I'm going to buy those, well, so far, you're actually down on that trade. So it's important to identify what it is that you want to focus on, figure out a way to systematize it, and really stick to it. You said something, your comment about doing better if you're trading less. I think there's some real benefit to forcing yourself to trade less. One of the things that we do at our firm too is we actually try not to react right away to big moves in prices. Because, like I said, markets can often overreact to certain pieces of news. So we actually force ourselves to give, it's almost like giving us a grace period before we can act on it. And sometimes that, I can't say that that's helpful every single time, but on balance, it helps us more than it doesn't. So having those kinds of discipline so that you sort of reduce the amount of trading that you do, for instance, could be something that's helpful. Another thing I'll say is in the public markets, especially discipline is even more disciplined, even more important because in the public markets, you're seeing prices move around all the time. And you have liquidity, which could be a great thing if you're trying to get out of a position or if you made a bad mistake. In private market investing, if you made a bad mistake, well, guess what? You're not going to be able to get out of it for a long time. Well, often, you're not going to be able to get out of it for a long time. And even if you have a good opportunity in private markets, unless you're somehow in the circle or have a relationship, you probably won't be able to get in. In the public markets, there isn't any of that. You can go in and come out, get out, at your will, very freely, very easily. But that also creates risk because you could panic sell, or you could go in and you could go in based on FOMO. One of the reasons why I was listening to Dawn Fitzpatrick, who's the CIO of Soros Fund Management, and she was talking about how, and this I've heard obviously from others too, and I think we can all appreciate, private equities performed as an asset class really well for a long period of time. But if you actually think about on a leverage adjusted basis, private equity as an asset class on a leverage adjusted basis is not necessarily like inherently superior to public equities. But in private equity, you don't get marks every single day. And even if you do get marks, you can't really sell. I mean, there is a secondary market for private equity, but it's obviously the liquidity is nothing compared to the public markets. So your inability to sell, therefore being forced to be long-term in that asset class is actually a very favorable thing to the investors. So the beauty, the sweet spot in public markets is if you could basically replicate that in the public markets, I don't see why it's not possible for a disciplined investor to generate private equity-like returns in the public markets, so long as you can stick to your discipline and follow your process. And in the long run, if you really know what you're doing, I don't see why public market returns or returns that you could harvest in the public markets needs to be any less than what you could get in the private markets.
I want to ask you something. You mentioned Don Fitzpatrick and Soros has been around for trading quite actively for probably a generation.
Yeah, yeah.
I remember when he started with with Sterling, and I was actually in the FX markets at the time. But I guess Soros and other funds like that use a fair amount of leverage.
Yes.
And I think as a result, they have stop losses. There's probably price-based stop losses where if a certain holding gets to a certain point, you have to stop out, and you may have to stop out and then think about it.
Yeah.
Is that, and it sounds like that's not something that you do, and you just mentioned that if something moves against you or moves for you, you take some time, you think about it. Is the requirement to use stop losses, a price-based stop loss, is that a function of leverage, or is it a different way of trading? How would you just give us some thoughts briefly on that?
Yeah, no, I totally understand why some firms need to have strict stop losses. Like you said, especially if you're running a lot of leverage, then obviously when you have a lot of leverage, you can basically get forced out of your trades. And so having stop losses so that doesn't happen to you, so that you're not forced out of your trades, is probably necessary. We're not fans of leverage. We think to a long-term investor, one of the most important, or one of the more important advantages that a long-term investor could have is the time horizon. That things over time often work out well, and you can actually sort of stay the course and not abandon your position, be forced to sell at the wrong time, for instance. When you run a lot of leverage, and I'm not going to say that all leverage is bad. I mean, I'm sure there are, depending on what you own, there's some level of leverage that the portfolio can probably afford to have and therefore absorb the volatility. But excessive amounts of leverage what ends up happening is you might have a 5-year view, very optimistic 5-year view on a company. Well, you have to be around for, you have to be there, you have to be around at the end of that 5-year period um, to actually see the benefits of the investment, the long-term investment that you made. If you get forced out of the trade, halfway into it, then what good was your 5-year view and the analysis that you did? So, leverage takes away that staying power, um, the ability to be long-term for a fundamental investor. Excessive amounts, I should say. Therefore, it's something that uh, we don't necessarily plan to pursue. Um, and even at the individual company level, when we invest in companies, we actually don't like highly leveraged companies at the companies that have a lot of debt, because companies go through cycles. The best example was in 2020 when COVID happened. Um, we didn't own many companies that had leverage on their balance sheet, and so we were able to be more confident that these companies will live to fight another day, because it's really hard to go completely broke as a profitable company when you don't have any leverage. Um, you'll survive, and as long as you can survive, um, you have a chance to thrive. So again, it's different for different investment strategies. I'm not going to say that ours is the best, but for a fundamentally driven long-term strategy, um, staying power is really key. And so anything that sort of takes away that staying power, I would say, is not really something that we're keen on having, or we want to have in our portfolio.
Right. And one last question, and
Yeah.
before I let you go, it seems like at Karani you do a lot of your own research,
Yeah.
different factors that you like. There are, and they're fewer now than there used to be, but there are a lot of sort of, I guess, professional analysts that cover certain names. Do you look at those analysts' reports quite closely? Is it a combination of looking at their reports and then diving more deeply into the names themselves? A lot of non-professional investors, some of our viewers,
Yeah.
probably won't be able to do a lot of their own research. So, is looking at some of the analysts who cover certain names, are they generally doing a good job?
Sure. I mean, it's a mixed bag, to be perfectly honest, and we sort of pick and choose as well. We if there's an analyst who's very good at what they do, in terms of the expert knowledge about a particular sector and industry, um, we pay attention. Obviously, we're learners, and we don't we don't know everything, and so obviously we we look to experts to better understand very specific industry dynamic, or um, something, an analyst who might have covered a company for a long period of time. We'll pay attention to, we'll read their materials to get a better understanding of those companies. That doesn't mean that we'll just take all of their whatever that they say at face value. We obviously will do our own work, and oftentimes we disagree. And when it comes to actual view on the stock, I mean, we will use experts to learn about the fundamentals of a company or an industry. But when it comes to the stock view, um, we don't. I mean, we may end up agreeing with an analyst about a view, where we think the stock is headed in the future, the risk reward um, embedded in the stock price. But we don't. Rarely do we just say, well, we should buy the stock because so and so at XYZ research firm said we should buy. Um, that's not something that we do, because expert knowledge, to a certain point, there is sort of direct correlation, I do think, between expert knowledge and your ability to pick stocks to a certain point. But after that, I don't think there's really correlation, because if expert knowledge is what if expert knowledge had perfect relationship with one's ability to pick stocks, then all the PhDs in the world would be the best stock pickers. But that's just not the case.
And they're not.
Right? So you obviously have to have there's a certain threshold of knowledge that you have to have, obviously. But beyond that, I think it's really much more about psychology and understanding the market dynamics, the market psyche, and your temperament as an investor, and being able to sort of use the market psyche to your advantage, to put on good risk-reward trades, make good risk-reward investments. So yeah, we'll use them, but we'll use them selectively. We're happy to learn from experts that are really good, and are happy to just kind of filter out the noise from those that we think aren't that good.
That's great. Well, thank you so much for coming on the show again.
Yeah.
Look forward to next time we talk, we dive a little bit more into the equity selection and decision making and the holding process.
Yeah.
Thank you so much.
Very welcome.
And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SomPro TV. You can check out the show anytime on our channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here on Monday. Have a great weekend.